If we look at it, robo-advisory may not have been called robo-advisory, but the concept itself was out when I first started working. In one of my first jobs, I worked for a financial planning firm back in Australia, and I still remember the advisors sitting down with clients, asking them, at what age are you looking at retiring? How much are you currently saving? What's your lifestyle? What's your risk appetite? And taking this data and then entering it into an Excel spreadsheet, which then he runs a macro and it comes out as a pretty graph. If we take this concept from that start date, robo-advisory has evolved quite a lot. It is now on the web. There's a little bit more intelligent calculations within there. It's able to factor in all the new and various funds which are coming through. That's grown. And then as it's evolving, they're doing many different things. So for example, there's robo-advisory not just on the funds, there's robo-advisory now for ETFs if the clients want that. So it becomes a combination of different products. In terms of maturity scale, I'd probably say we're at the middle of the life cycle and there's a lot more. And we're seeing companies sort of try and put in more. An example in Taiwan, one of the major distributors in Taiwan rolled out a robo-advisory service, but they coupled it with a managed account service, which meant that the account would rebalance itself. So they sit down with the clients, they have a sort of target portfolio, and if the portfolio changes over time, it will then trigger off automatically a buy or sell to rebalance everything. And so it is evolving over time. Firstly, I think for wealth advisors within the region and globally, one of the most important things is regulation. As we can see after the financial crisis, regulation has evolved. There are more and more regulations. So when a wealth manager is selling to clients, they need to ensure that they're abiding by all these new regulations which are coming through in order to protect the underlying investor. Secondly, there is the operational efficiency side of things. With all wealth managers, their year-on-year budget is to increase and the number of clients do increase. And like all companies, they need to begin to do things more efficiently. And one of the main aspects that we're seeing a lot now is a lot of these companies now have digital strategies. 5 years ago, 10 years ago, these wealth advisors would never think about having a digital strategy. So they're looking at different ways to engage with their clients and become more efficient and continue on doing the business that they've been doing with a lot more clients. Thirdly, products. In the modern society, clients are looking for new choices. More and more products are being distributed or created by the fund manufacturer. There's different nuances within that. It's important for the wealth advisor to understand all these products and be able to explain to their clients in perfect details so that the clients do understand the risks and know what they're getting into. However, as we're going along, these products are becoming slightly more complicated and the different permutations and combinations of these things does complicate. So you can imagine from a wealth manager perspective, having to understand they may have 20 different fund managers which they're selling, and of these there may be another 20 different funds, and what are the differences between the funds? Some may be in different currencies, some may be slightly leveraged. These are things which the wealth advisors need to ensure that they're on top of in order to better service their clients. I think the most important thing for a wealth manager is that they can't go in with a robo-advisory thinking that it is a standalone strategy and it's a strategy to save the company or make the company grow increasingly fast. My view is that robo-advisory is one of the tool sets which potentially can attract new clients, but you still need to have your core financial advisors in place. So they do complement each other. Different clients require different types of servicing. Some would really still like to speak to clients, while others may just wish to go online and be able to do what they need to do and enter in the information and be able to invest their money rather quickly. My view is that robo-advisory is one of the tool sets which potentially can attract new clients, but you still need to have your core financial advisors in place. So they do complement each other. Different clients require different types of servicing. Some would really still like to speak to clients, while others may just wish to go online and be able to do what they need to do and enter in the information and be able to invest their money rather quickly.